For more insight into China's outlook specifically, CGTN's Shu Tao spoke with the IMF chief economist in a one-on-one interview. Here's what they had to say.
So in the case of China, so this is the flip side. The U.S. supply shock increases inflation, lowers activity. In the case of China and other countries, it's a negative demand shock. So the demand for Chinese goods is going to be reduced because of the tariffs that are imposed by the U.S. And again, the uncertainty also is a factor that reduces demand for goods and economic activity more generally. So we're seeing a downgrade in Chinese growth for 2025 to 4%. We were projecting 4.6%. Now we're projecting 4%. Now, in fact, the impact of the tariffs on the Chinese economy, in our assessment, is quite large. The tariffs by themselves would reduce growth in China by 1.3 percentage point. But there are other things that the Chinese economy and the Chinese authorities are doing that are helping to offset some of this. So there have been a number of measures in terms of fiscal support that have been announced since the beginning of the year. And this is providing some support to the Chinese economy, and that's why we land with only a 0.6 percentage point downgrade. Now, the other effect of a demand shock is it lowers activity, but it also lowers inflation. And so we are seeing a downward revision that is quite significant for the Chinese headline inflation numbers, from 0.8% to 0. We're basically expecting no inflation in China in 2025. And of course, you might say, well, no inflation is good. Well, not quite, because you don't want your economy to go into deflation. You don't want inflation rates to become negative. That is also a situation that is difficult to manage.